Good evening, ladies and gentlemen. This is Barry Norman on behalf of CMS Trader, that is Capital Markets Trader and Investing.com. And welcome to our class on moving average convergence and divergence, or better known as MACD, one of the most useful indicators that you can use for trading CFD, Forex, stocks, futures, and just about any market that has any activity or volume. Now, tonight's class is brought to us by CMS Trader, that's Capital Markets Traders. And if you like during class, if you go to www.cmstrader and just click on the buy or sell button, you can open a demo account immediately. And there's no credit card required. And then you can use the charts and the MACD indicator on their platform to follow along with us in tonight's class. Now, because CMS Trader is a regulated provider, I'm required to give you a risk warning. So let me read that and get it out of the way. Trading Forex, CFD, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure that you fully understand the risk and take care to manage your exposure. So as I said before, if you locate the platform at www.cmstrader.com and you click on the buy or the sell button, it'll ask you to input your email address and select the password, and it'll open a demo account. Now, if you go to www.cmstrader.com and are unable to access anything, it's because CMS Trader is not regulated in your country, and CMS Trader only provides services where they are regulated and provide lawful services. So again, it's www.cmstrader.com. And they offer impeccable service, outstanding education, and all the tools and services you need to become a successful trader. Now, they offer a wide range of instruments, including Forex and CFDs for stocks, commodities, and indices, as well as cryptocurrency. You can use their social media, social trading platform, and just use their watch, copy, and profit, where you can follow along with the best traders on the platform, and you can select one or to follow and make your own trades based on what they're doing. Or you can learn how to become an independent trader with CMS Trader, and you'll get one-on-one sessions with a financial expert. You'll get all types of video tutorials for professionals and beginners, and a wide array or a full library of ebooks. So let's move forward with our class on moving average convergence and divergence. And the big question everybody wants to know, does it work? Now, Gerald Arpel, who is very, very well known in the trading markets as a technician, and over the years has developed many different indicators. Well, in the late 70s, he developed the moving average convergence divergence. Now, I like that name, but it is a mouthful to say. So we're going to refer to it as the MACD like everybody else does. Now, it is actually one of the most commonly used momentum indicators around today. It works well in any market and is used to spot changes in strength, direction, momentum, and the duration of a trend. Now, originally when Arpel developed this, really the only thing out there was the stock market. You know, you had a couple people trading in futures market. There was no online trading, and everybody else was brokers that were working in brokers' offices or in, on the floors. But the MACD is one of the most popular and broadly used indicators for Forex trading today. Now, over the years, Arpel jingled it and jangled it and made it more relevant. And then with the development of online trading, it was again updated so that it works well for online traders and covers any market that moves out there. Now, the MACD indicator also gives us three different pieces of information, or it serves as three indicators. It will give us entry and exit points. It will show us divergence, and it will also show us overbought and oversold markets. But before you can figure out or decide how to use this indicator, you need to understand where all the different pieces of it come from, because that way you can spot changes, you can spot when the indicator is not working properly in the market you're looking at, or you can notice why things aren't doing exactly what they should be, and you can start applying your own abilities to use this indicator. Where if I just told you do this, do that, and do that, when this happens, you're not using the indicator. You're just using whatever the words that Barry told you. And I want you to fully understand how to use this indicator. And in order to do that, you have to understand where the information, where the mathematics come from. It's not complicated. And once you've learned it, once you understand it, you never have to go back and learn it again or deal with it again. But tonight, we're going to go through all the steps involved in building the MACD indicator onto your chart. So the concept behind MACD is fairly straightforward. Essentially, it calculates the difference between an instrument's 12-day, or what we're going to call day, but we call it 12 period, and 26 period exponential moving average. Now, of the two moving averages that make up the MACD, the 12 period EMA is obviously the faster one, while the 26 period is the slower. Now, a moving average, as we all know, is simply you add a certain group of things together and divide it by the number of the group, and you get the moving average. So in other words, if we were going to look back 12 periods of trading, and we were looking at a 1-hour chart, we would be looking back over the last 12 hours. And we would be taking the close of that asset, that price asset, at the end of each hour, adding it all together and dividing it by 12. Now, we use a 12-period EMA, and now what an EMA does is called an exponential moving average. Technically, it's a mathematical calculation, but it just simply gives a little bit more weight to the most current prices. Now, we also use a 26-period moving average, which is called the slower moving average. Why? Well, always when you're using two moving averages, the more periods you cover, the slower it responds to current market conditions. So hypothetically, say gold was trading 26 periods ago at 1200, say 1200, 1200, 1200, all for the next 24 periods, and then jump to 1225 and 1250. Well, if you were to add all those 1200s together and then the 1225 and 1250, you would see a minor fluctuation because it's being that movement is being divided by 26. So it responds slower to the market because when you're using the 12-period moving average, it's going to use the 1225, the 1250, and then the 1200s, but only going to go back 12 periods and then divide by 12. So it's going to respond or change quicker than the 26 period. So let's go put those on a chart and see where we start from. So hold on, let me pop up a chart on our screen. Okay, so we're looking at the euro US dollar in a 30-minute chart, and it's the current live chart. Now I've dropped on here two EMAs, moving averages. Okay, so we have the blue moving average, which I've used for a 12-period moving average, and the violet moving average, which I've designated a 26 period. Now, it's pretty simple. We just went on to the inputs, and I selected the color, and I selected the input, and I set it at 12. But don't worry about this. You'll never ever have to do this. But I'm showing you the steps of where we go through to get the MACD. So now we have these two moving averages on our charts. We have the 12-period EMA in the blue. That's this one right here. And that is the faster moving average. And then we have the 26-period moving average in the violet, and that's the slower moving average. Now, if we were just to use these moving averages and trade the crossovers, we're simply trading a moving average crossover strategy. But that isn't what we're doing with MACD. This is just the beginning of determining the MACD indicator. So now what we do is to get the MACD, we subtract the purple or the slower moving average from the faster moving average. And the difference between those two are plotted on the bottom of our chart. Now, if we subtract one from the other, we're going to either have a negative number or a positive number. And whenever those number equals 0, what do we have? We have the two moving averages crossing over, because when they cross over, they are exactly the same number. So when we subtract one from the other, it's always a 0. So the first part of our MACD line goes down below on the bottom of our chart, and I've got that in red, and that's called the MACD line. This MACD line is drawn over top of a 0 line. So we draw and set up on our charts a 0, and whenever it's crossing the 0 line, I'm not drawing such a straight line, but whenever it crosses that 0 line, we know the moving averages just crossed over each other. When it crosses over and gets larger, that's moving into positive territory. So we know at that point that the slower moving average is larger than the faster moving average is larger than the slower moving average. Just like we see here, the blue line is larger than the violet line. So when we take the blue line and subtract the violet line, we get a larger positive number. When the blue line falls below the purple line, or the slower moving average, the faster moving average is, the slower moving average is larger than the faster moving average, we would get a negative number because we're subtracting a smaller number from a bigger number. We're subtracting a bigger number from a smaller number. And when we do that, it would come into the 0 range. But in order to do that, at some point, it had to be 0 because they had to cross over for that exchange to happen. So we can see at this point, they crossed over. At this point, they crossed over. Now, this is just the basic first step in coming up with our MACD line. Because again, if this is all we were doing, we're basically just trading a moving average crossover strategy. So we no longer need our two moving averages that we put on our charts, because they've now been incorporated in the MACD line below. And when you drop MACD on your charts, it never puts a moving average up above. I did that for you to see. So now we have our MACD line down below, which is the 12-period moving average minus the 26-period moving average. Now, we then take our MACD line and come up with a 9-period moving average. So we would take the last number of whatever this MACD line was for each of these periods for 9 periods back, and we would add that together and divide and come up with the 9-period moving average. And we would then plot this on our chart, and this is called the trigger line or the signal line. And now we have that on our chart below. So we have our red line, which is called the MACD line, which is the difference of the two moving averages above. And then we have the trigger line, which is the 9-period moving average of the MACD line. Now we would want to look at crossovers, because now we have a derivative of a derivative of a derivative of a derivative. So instead of being just a moving average crossover strategy, we now have one step beyond that, because now what we're doing is we've built the signal line, or this trigger line, that when it crosses over the MACD line, it's giving us what's called transaction signals. It's giving us buy or sell signals. So in other words, at that point right there, that is telling us to either buy or sell. At this point right here, it's telling us to either buy or sell. At this point here, it's giving us a transaction signal. This point here is giving us a transaction signal. That point there. Now, what is it? How is it a buy or a sell signal? Well, when the MACD line, which in this case is the dark red line, crosses above and over the signal line, it's a buy signal. If it crosses over, below, and under, it's a sell signal. So again, we have our zero line here. And when we have the MACD line here, the red line, and it crosses over the blue line and goes underneath of it, it's giving us a sell signal. When it crosses above the blue line, it's giving us a buy signal. You follow me? Well, we'll get into it a little bit more once we've added, and we'll go over transaction signals, but we have to add the last part of this puzzle onto this chart. Now, we have the last part, which is called a histogram. A histogram takes these two lines, the MACD line, the MACD signal line, and subtracts them and puts them in a very easy to see visual representation so that you don't have to do any calculations. So we've got our MACD histogram set up here in the green. And the MACD histogram is also based on that zero line, because it's simply the MACD line minus the MACD signal line. And so when we put that on the zero line here, every time the two are equal to one another or crossing, they are at the 0 point. And every time that they are at 0, they're either going to move up and separate or down and separate. If we see it cross the 0 and move up, in other words, build a mountain instead of a valley, it's a buy signal. When we see it go down and form the valley, it's a sell signal when it bought it. The difference between the two, or the more significant the movement is between the two, the higher or the lower these valleys will be and these mountains will be. When you get large mountains, in this case we don't have any, okay, that's also telling us what kind of momentum it has, and could also be telling us that the markets are kind of getting overbought or oversold. So when we see that the MACD line and the MACD signal line pull far away from where they are, that is telling us we have an overbought, in this case, an oversold condition. Now, when we see this rapid rise, because what happens is we got this rapid rise, but the MACD line and this signal line, which is just the moving average, stayed pretty much equal and rode on top of each other. So we don't see that much in the histogram, but we see it all staying at 0. But we saw this huge push down here in value. So what we're looking for are the peaks and the valleys and the mountains and the hills made by the histogram, the crossover of the 0, and these huge mountains that are made by price variance away from the 0 line. Now, we'll talk about what they all mean in a second, but this is it. We are finished putting the MACD histogram or the MACD indicator onto your charts. Now, a lot of us, only use the histogram. I don't use an overbought and oversold condition, so I only use the histogram. So technically, I could actually change this to be just like that, and I can see everything I need to see in that histogram. And once you trade it with MACD long enough, you will start to be able to see everything you need to do that, and you rely strictly on the histogram. But as a beginner, you want to rely on the signal line and the MACD line and its variance from that histogram, and also the movements and the crosses of the zero line with the histogram. So now that we've put it on a chart, let's go over and talk about what all this might mean to you. So let me take you back to the PowerPoint. So remember, we had the MACD line, the MACD signal line, and the histogram. And some of you who may not have followed it, because it sounds a little bit confusing, although it really isn't, but it's just a lot of words. And I've tried to make this as easy to explain as possible. I've taught this class a lot, but it's still a lot of words to explain with a lot of lines. So the MACD histogram is just an elegant visual representation of the difference between the MACD and its 9-day EMA. The histogram is positive when the MACD is above its 9-day EMA and negative when the MACD is below its 9-day EMA. If prices are rising, the histogram grows larger as the speed of the price movement accelerates and contracts as the price movement decelerates. The same principle works in reverse as prices are falling. So remember this. If prices are rising, the histogram grows larger as the speed, and this is what we're talking about, the momentum, the speed of the price movement accelerates. So the price movement is accelerating up on the charts. And this is when we would, if we see this huge peak or this huge rise, this is where we would see the overbought or oversold condition. The same principle works in reverse as the markets decelerate. So the moving average convergence and divergence indicator is both a momentum oscillator and a price-based oscillator, as one of the more reliable studies that we have. Now, while it is a lagging indicator, it works well in all time frames and with all stocks and futures contracts, Forex contracts, and futures. It is a highly interpretive probability signal that is based on the differences existing between 3 moving averages and its histogram. Why 3 moving averages? What did we have? We had the 26 period, the 12 period, and then we had a 9 period moving average. While it is slower than momentum indicators such as stochastics and RSI, if you are willing to sacrifice a little speed in exchange for safety, it's good at keeping you on the right side of the markets. So again, we take the 9 period EMA, the 12 period and the 26 period EMAs, and we then subtract the 12 period from the 26 period. So, and that gives us our MACD line down below. Then we take a 9 period EMA of that MACD line, and that gives us the signal line. And then we can then take the differences and put those on the histogram. And the MACD line minus the MACD signal line gives us the number that's placed on the histogram. And we can see the peaks and the valleys growing on our histogram. Every time it crosses 0, It's because the MACD and the signal line crossed each other. It's not this cross, it's this cross that it's giving you. Now, the MACD is perhaps the best all-round study available. Indeed, I myself consider the MACD to be the best single oscillator available, and its value to learn its nuances inside and out. And that's why we're going step by step, because I want you to learn each part of this inside and out. So in downtrending markets, the faster moving average will move down faster than the slower moving average. As the fast moving average diverges from the slow moving average, MACD will illustrate that relationship. And in uptrending markets, the 12-period EMA should move faster than the 26-period EMA. As such, MACD will move higher to express this growing difference between the 12 and the 26. Now, notice that the MACD helped traders notice that the trend changes from very early stages. As the blue box here shows that the MACD indicator showed us that this trend was changing right here, well ahead of actually seeing that trend in the prices. Even though it's a lagging indicator, it will show us more precisely in the indicator what's happening with the price movement. This is a key part of the indicator and something we will delve into much later. Now, in an effort to more closely follow the relationship between the MACD and the signal line, traders can follow the histogram, which is simply a bar chart plotted around the zero to indicate the relationship between the MACD and the signal line. Now, once we've got the MACD on our chart, okay, it gives us three different stories, or it gives us three valuable pieces of information, and you can use it however you care to use it. But it gives us crossovers, overbought and oversold conditions, and divergences. So crossovers are referred to as transaction signals. The basic MACD trading rule is to sell when the MACD falls below its signal line. So when MACD falls below, so when the MACD crosses over and goes below the signal line, it's a sell indicator, like we can see right here on this chart. See how the MACD, in this case, the MACD line's the black, it crosses its signal line and falls below. That's a sell signal. Here, the MACD line crosses up and over the signal line, and that's a buy. Here, it crosses below, and it gives us a sell. Here, it crosses above, it gives us a buy. Now, the MACD will generate a great deal of buy and sell signals, or buy and sell alerts or transaction signals. But what you've noticed, or what you see missing in this conversation, is MACD will not tell you the strength of that signal or how far that buy should hold. So MACD generates a lot of signals, but a MACD on its own will not tell you whether it's a signal worth trading. You have to do this with using risk management and other tools, because MACD will give you what we call false signals, which are more, not that they're not correct, they don't last long. They're gone in a matter of a minute, and there was no money you could have made. And because MACD is not based on the bid and the ask price, it might not even allow you to cover the spread. So when it's giving you these transaction signals, it's giving you a buy or sell alert. Okay, you have to determine how strong that buy or sell, or how much, or can you make that trade. The other thing MACD will do, it will give you overbought and oversold conditions. The MACD is also useful as an overbought and oversold indicator. When the shorter moving average pulls away dramatically, and remember dramatically, from the longer moving average, i.e. the MACD rises, it should likely that the symbol price is overextended and will soon return to more realistic prices. So when you see a huge mountain or a peak, a mountain or a valley, imagine it's that Hawaii volcano. It's telling you the markets are overbought or oversold. Then we have divergence. Divergence is one of the hardest things to see on a chart anytime and isolate. But when you do, okay, you have a pretty good a valuable piece of market information. Now, in the MACD, we get a divergence. Divergence is always classified or explained as the same thing as when the price action moves in one direction while the indicator is moving in an opposite direction. So in other words, here we see price in a downtrend and price is making lower lows because that's what defines a downtrend. So the price is making lower lows while the MACD signal, the MACD line or the MACD value is making higher lows. So in other words, we saw this is the lowest point the MACD made at this point. And now at this point, it's much higher than it was, or we could have drawn a line between, or a trend line between the two, and it's diverging from the trend line that we have on the charts. So the chart, the price action chart is showing lower lows, while the MACD line is showing higher lows. Then when we get the crossover from the signal line, that's giving us a breakout point, and that's telling us that the trend has ended. And it is also, in that case, when you see divergence and then you get the crossover, that's giving you a very good breakout point and an entry point into the markets. So an indication that the end of a current trend may be near occurs when the MACD diverges from its symbol. A bullish divergence occurs when the MACD line indicator is making new highs while price fails to reach those new highs. A bearish divergence occurs when the MACD line is making new lows while price fails to reach new lows. Both of these divergences are most significant when they occur at relatively overbought or oversold conditions. So if you can combine overbought and oversold, divergence, and a crossover, you've got something that's screaming at you as loud as it can to either buy or to sell, depending on which way it's going. So a bearish divergence forms when a security records a higher high and the MACD line forms a lower high. So in this case, we see the divergence when the indicator, the MACD signal line, is making lower highs, but the price is making higher highs. Again, we get the crossover here, which is the breakout, and is giving you a very, very strong sell alert. So remember, the MACD, especially the MACD histogram, is an indicator of an indicator. Actually, it's 4 steps removed. It's an indicator of an indicator of an indicator of an indicator. It's got 4 derivatives. Okay. The first derivative is the 12-period EMA and the 26-period EMA. That's right, done on actual price movement. The second derivative is the MACD line that goes below, which is a 12-day moving average minus the 26. The third derivative is the MACD signal line, which is a 9-day moving average of the MACD line. And the fourth derivative is the MACD histogram, which is the MACD less the signal line. So we've actually massaged that data pretty well. And this is why it isn't a moving average crossover strategy, but a lot more defined. It's an indicator of an indicator. Therefore, it is designed to anticipate signals in MACD, which in turn is designed to identify changes in price momentum of the underlying security. So it has become standard to plot a separate moving average alongside the MACD signal line. Okay, and this signal line is also sometimes called a trigger line. Why? Because it triggers buy and sell signals. So the bearish bullish signal, or the buy sign, occurs when the MACD line, the solid line in this case, crosses above the signal line. And the basic bearish signal is generated when the MACD crosses below the signal line. Traders who attempt to profit from bullish MACD crosses that occur when the indicator is below zero should be aware that they are attempting to profit from a change in the momentum direction. So one of the other reasons that we plot the zero line is we want to look at the relationship to the buy and sell signals that is generating and where they are in relationship to the zero line. So let me reread that to you again. Traders who attempt to profit from bullish MACD crosses, that means a buy, that occur when the indicator is below zero, should be aware that they are attempting to profit from a change in momentum direction, while the moving averages are still suggesting that the security could experience a short-term sell-off. This bullish crossover can often correctly predict the reversal in the trend, but is often considered riskier than if the MACD were above zero. So you should be buying above zero and selling below zero, or as close to the zero line. As mentioned earlier, the MACD indicator is calculated by taking the difference between the short-term moving average, the 12 period, and the 26. Given this construction, the value of the MACD indicator must be equal to zero each time the two moving averages cross each other. Okay. And this is something you have to keep in mind. A cross through the zero line is a very simple method that can be used to identify the direction of the trend and key points when momentum is building in an asset. The biggest disadvantage of using this indicator to generate transaction signal is that a trader can be whipsawed in and out of a position several times before being able to capture a strong change in momentum. And that's what I mentioned to you earlier. It's not really false signals, is that you can be whipsawed in and out because the signals aren't telling you how long they're going to last or how big the move will be. So traders should always be aware that the whipsaw effect can be severe in both trending and range-bound markets because relatively small movements can cause the indicator to change direction quickly. A large number of false signals can result in a trader taking many losses. When commissions are factored into the equation or the bid-ask price, the strategy can become very expensive. So the MACD indicator is one of the most popular tools in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. The clear transaction signals help minimize the subjectivity involved in trading, and the crossover of the signal line makes it easy for traders to ensure they are trading in the direction of the momentum. Very few indicators in technical analysis are proved to be more reliable than MACD. And this relatively simple indicator can quickly be incorporated into any short-term trading strategy. So if there were ever a quest in investing on par for the search of the Holy Grail, it would be acquiring the ability to spot trend changes. There are many ways investors attempt to do this with varying degrees of success. But a common trend tracking tool is a two-line moving average convergence and divergence. This tool measures an asset's momentum and can aid traders in spotting changes in market sentiment. So just like in physics, momentum changes occur before the price of an asset changes. So remember, life happens. Trading is rarely black and white. Some rules that traders agree on blindly, such as never adding to a loser, can be successfully broken to achieve extraordinary profits. However, a logical, methodological approach for violating these important money management rules needs to be established before attempting to capture gains. In the case of the MACD histogram, trading the indicator instead of the price offers a new way to trade an old idea, divergence. Applying this method to Forex markets, which allows effortless scaling up positions, makes this an even more intriguing to day traders and position traders alike. So remember, MACD is a triple header. It gives you 3 pieces of information. It's also easy to use, easy to understand, and easy to add into your trading strategy. It's not very complicated, but MACD has been around for almost 50 years, and it's one of the most widely used indicators. If it's lasted that long and still so popular, it means that it's pretty reliable. So you can find that MACD should be added into your trading strategy at the earliest stages, and combined with trends, volume, and support and resistance lines can make you an excellent trading strategy. Just give you something easy and reliable that doesn't take much complexity. Because remember, ultimately, it's price action that dictates what's going to happen, and it's risk management, money management that will keep you from losing your shirt. So on that note, I'm going to say goodbye to everybody. And if you want more information, go to Capital Markets Trader, cmstrader.com, and watch their videos and use some of their education and learn more about MACD there. Thank you very much and have a great week. Bye now.